6% withdrawal rate and a 30 years time horizon. So what we can see in our example here is the tremendous effect that volatility has on the outcomes. You can see that with a 10% standard deviation, a low-risk portfolio, only 1% of the portfolios experienced a failure. But if we double the standard deviation of the portfolio to 20%, which isn't really a very highly risky portfolio, 23 times as many failures occurred, 23%. So volatility is a key determination of whether or not your portfolio is likely to survive your retirement. So what do we get from this? Failure rates are directly related to time horizon, rate of return in the portfolio, withdrawal rates, and volatility. Incidentally, when we do this, mortality doesn't significantly alter the results for younger retirees. Just isn't a big factor. So what should you do? First, you got to use very conservative withdrawal rates. We see that at rates above 6%, you have a significant chance of failure, although we think 4% is a safe rate. Controlling the portfolio volatility is really critical to this whole process. That means for equities, cross-border diversification, wide asset class diversification, and perhaps a value tilt. Then you have to have a good slug of bonds, short-term, high-quality bonds, to give you the liquidity you need to withstand the down markets. Even then, mid-course corrections may be required. That means someday you may have to cut your withdrawals temporarily to prevent the portfolio from self-liquidating. So of all the factors that determine whether or not a portfolio is going to survive, the only one directly under the control of the retiree is the withdrawal rate. The retiree has some control over the volatility of his portfolio through portfolio construction. He has little control over the rate of return, especially in the short term. He doesn't have any control over the date of his retirement in some cases. That may be forced upon him. And of course, unless he wants to call in Dr. Jack, he's got no control over his lifespan. Let's take a look at how a retiree can generate a portfolio that's going to give him the highest probability of success. That is, the highest probability of not running out of money while he's alive. First, of course, we got to have a withdrawal rate that's sustainable. Then we need to generate a total return to support the withdrawal rate, not simply income or growth, but a combination of growth and income that'll support his withdrawal rate. It's critical that we limit the volatility of the portfolio. The way we do that is wide diversification. We want to conserve our volatile assets during market declines so that the volatile assets can live to fight another day. We need to control taxes, limit expenses, and perhaps limit our withdrawals to some tolerable amount. Then, of course, along the way, we've got to keep our estate planning up to date. Again, it's critical to control the risk in the portfolio. Diversification reduces risk, and in this case, we mean global diversification into multiple asset classes. Again, reducing risk increases the highest probability of success. And within a broad range, controlling the risk is far more important than attempting to boost returns. You'd be better off in some cases with a lower return and a lower risk than a higher return and a higher risk. On the fixed income side, don't stretch for yield. That means we want to have a portfolio that's rock solid as much as we can make it. Very short durations, high quality. By that I mean primarily government guaranteed obligations of 1 to 3 years, so that as interest rates change, the portfolio won't change very much, if at all. On a macro level, the best way to control risk is to balance the ratio of stocks to bonds or equities to fixed income. I call this the two-bucket strategy. Think about a large bucket of short-term bonds and a large bucket that represents the global equity portfolio. And the difference between investors is how much in each bucket they should have. Again, the bond bucket is very short-term, high quality. In this case, we don't want this bucket to go anywhere at all as interest rates change. Most people don't realize that there's as much volatility in a 20-year Treasury bond as there is in the Standard & Poor's 500. But there's only about a third of the total return. That's not a very good trade-off. We want our bonds to be absolutely rock solid. If we have an absolutely rock solid bond portfolio, then we can afford to take some risk in equities to generate the higher return that we need to meet our long-term goals. But we still need to manage the risk. We want to diversify as widely as possible into multiple asset classes, multiple styles, cross-border diversification, perhaps a small in value tilt to pick up some additional yield. But we want to have the minimum risk position we can in the global equity markets. So what we're going to do here is divide our assets into two big buckets. On the bond side, we're going to have enough to generate 7 to 10 years of your income needs minimum, even if the bonds don't make a penny. And with that much set aside, we can withstand the down markets that are invariably going to come. The balance can go into equities if you prefer. However, we don't want to put more in equities than you can stand either financially or emotionally, because the worst thing you can do to yourself is bail out during down markets. This is an example of an asset allocation plan that might work well for the typical retiree. You can see we got a big slug of our short-term high-quality bonds and then 9 different asset classes in the world's equity market. Pretty well balanced between foreign and domestic. Additionally, we could add in foreign and domestic real estate and commodities futures. Depending on results, on a year-by-year basis, so we can impose a withdrawal rule so that in bad years, we're going to withdraw exclusively from the bonds to allow the equities time to recover. We want to protect volatile assets in a down market. In a good year, we're going to shave off whatever income needs we have from the equity portfolio and then use any balance to restore the balance between the stocks and the fixed income. We've done some testing on this, and we find that the optimum rule is that when the equity return equals the withdrawal rate, that's a good year, and we can take from the stock side. Anything less than that, we just draw down the bonds and wait for the equities to recover. There's absolutely no evidence anywhere that active management, meaning the individual selection of stocks or market timing attempts, adds any value at all to the investment process. Actually, active management reliably adds cost, increases taxes, and increases risk. So we're going to implement using no-load index funds and exchange-traded funds. That's going to provide the lowest cost, the lowest tax, and within each individual asset class, the lowest risk that we can achieve. Taxes are one of the highest expenses that the investor faces, so we want to pay particular attention to the distribution of assets between the IRA, tax-qualified plans, and personal accounts. We want to take the assets which are tax efficient and put them in your personal accounts, and the assets that might generate additional tax aggravation and put them inside the qualified plans. Then if your tax bracket's high enough, we'd use municipal bonds, and we want to do what we can to limit the turnover in the portfolio to reduce these costs. Beginning about age 70 and a half, you're going to be faced with required minimum distributions from your qualified plans. After all, the IRS has waited your entire working life to begin to tax that money, and they want their share now. If your IRA or other qualified plans are particularly large, you may want to adopt a strategy where you level those income payments out so you can reduce your total tax burden over your lifetime. Another thing you may want to consider is a Roth conversion. If you're willing to prepay the taxes for your descendants, you can save an enormous amount of funds in your estate. Speaking of estate planning, at all points in your life, you'll want to make sure your beneficiary designation, trust, wills, limited powers are up to date. Thanks for listening in today. I've tried to cover some of the most important issues for investing during retirement. If we can help you with your individual plans, please feel free to contact one of our very highly qualified advisors. Thanks again.